Okay, welcome guys to the Crypto and Coffee podcast. As per usual, I'm joined by my two co-hosts, Cordell Tanny and David Blackstone. And in today's episode, we'll be talking a little bit about monetization in Web3, right? So I think a great opening line here is, what does monetization actually mean in Web3 versus traditional startups, right? Because with Web3, one startup in Web you can monetize several different ways, right? You can have transaction fees, you can have interchange fees, you can have stuff like NFT fees, all that kind of stuff, right? So, Corda, from your standpoint, what's really is the difference between monetization in Web3 and traditional startups? Just to give an overview.
Well, I don't even know if I would start it with such a granular thing, Web3 versus that, because there's still going to be a lot of things that are in common from all businesses in terms of monetizing, right? I mean, if you just go back, I mean, first of all, the quality of the business model. If you start with your business model right away, I mean, traditionally you've had two methods of monetization, two main business models. One is what you would call transactional, as you get paid by the transaction. And the other one is what you'd call the annuitized model, which is more subscription fees or something like that. So, you can see the difference. Transaction, you're constantly chasing the next transaction. You're only making money as long as the transactions come in. So that was like, the initial way, especially in the financial world of the business model, just because that way you have a transaction, you had people pushing each transaction, selling each transaction, you make money. But of course, that's labor intensive and you're always dependent maybe on a business cycle. So to remove some of that sensitivity of cycles, you come up with the annuitized model, which is you pay a flat amount and then you get the service for a year. So a lot of industries had moved away from the transaction model to the subscription model. And one great way to look at it is how many subscriptions we have right now for Netflix, YouTube, even our AI services, how many people just have Claude, or if you have Claude, Gemini, Grok, all of them. So, that's all based on the subscription model. And it's come to the point where it's been so ubiquitous. I think most of us are getting a little bit subscription, getting very tired of how many subscriptions. I mean, if you go back to, I remember when I cut the cord for TV, it was back in 2009 when I moved into the house here. And the cable company was like, we don't put in cables anymore. You have to hire an electrician to do it yourself. And we're like, what the hell are you talking about? That's your job. Your job is to connect a TV to the cable. Like, sorry, we don't do that anymore. So like, okay, we're just going to cut the cord. And I remember customer service like, what do you mean? How are you going to watch TV? Like, they were shocked. They had never heard of somebody cutting cable. And we said, well, look, don't need it anymore. Don't need to pay your high fees to get all of these channels that we don't watch, and that's exactly where the subscription models come today. And we're now drowning in 20, 30, 40 subscriptions where you can't even keep track of them anymore. So that has just been the evolution of the business model to get you to this subscription model. So it's not whether or not it works or doesn't work. That's just a little bit about the history and how we got there. So how that becomes specific to the Web3 then also depends on the product. So the business model that you're going to do and how you're going to try and monetize it is going to depend greatly on the product, the problem, and how your product solves that problem. So I think you really need to start with a careful analysis of that before you just start saying, oh, hey, what's the bet? How do we monetize it? So you need to do a real careful analysis of what your actual situation is.
Yeah, and I completely agree. But if you look into it a little bit more, right, Web3 projects or startups really do have I would say, a specific model most of the time, right? Every single startup may have transaction fees, interchange fees, payment fees like that, right? But Web3 startups normally would have, like, sometimes NFT fees, maybe ETFs, stuff like, anything related to like the blockchain or payment on the blockchain is like specific to their monetization.
Well, in that case, you're looking at a transactional model, right? So that's what I'm saying. If we're going to go into that kind of product, like, let's say like Uniswap, if we think about Uniswap as like, the canonical example, it's a transaction-based model, right? You're clipping pennies or whatever it is off every trade, and then you need scale. So if that's what you're kind of do, I mean, remember, it's like there's a trade-off, pros and cons to everything. So if you're a transactional based model like that, you're after scale. So then if that's the, how do you achieve that scale is the issue then, right? It's like you have to get your network, your protocol, whatever, to be the one that's going to generate enough traffic to make enough money out of it. So monetizing it, a transactional model, is about scale. And that's like the key thing when it comes down to a transactional model like that. If you're going to start thinking about, let's say, the tokenizations or something like that, the token is, part of the incentive. When you're building the tokenized stuff, you're rewarding people with the tokens normally as well. So, those token economies can easily evolve from, I guess I would call it like a speculative tool into a growth engine. But that's really how, that's a little bit of the difference between the tokenization and the transactions. So, if we're talking about the tokens, like, does token ownership create a utility? That's what I would really think about on the token side. Like, how much utility do you get out of the token? Or are you just betting on a price going up? I mean, that's like tokenization, you're betting on the price going up, really. That's the model. So,
Yeah, and I completely agree. But one of the things I wanted to ask you, based on the argument that you just had, or the statement that you just made, right? But I want David to answer first. Does every project really need a token? Does it really?
No.
No.
No. With exchanges and such, you have a lot of them that have introduced tokens either when they came out or afterwards, trying to go to their own blockchain. I don't think you need tokens yourself at any level. Well, maybe not at any level, but there are ways to do things without tokens in most cases. If you want tokens, you need to have a reason for it. Like with Ethereum, they created that as a means of judging the amount of that's moving through the chain. Same for Bitcoin. With regards to Symphony, I put it in as a medium of exchange in the same way that you now see with bricks and the unit. The unit in this case is the intermediary, the item that stays a certain value, and the other units move through that, as opposed to through something like the yuan, which would then put the yuan as the backing currency of the world. Instead, they've made it this neutral thing. That is the purpose of a unit on a blockchain. That's the purpose of having a token on a blockchain, to have this neutral thing that you can move through, instead of, for example, anything else. If you have a game, if you're putting a game on a website, you don't need a token. If you have an exchange and it sits on a singular blockchain, you don't need a token. If you have an exchange on your own blockchain and it's not moving through, you're not moving anything through that token at all, it's just there as a way for people to buy into your company, you don't need a token. The blockchain itself is a set of blocks of data. It's it's a record. It's a bunch of different accountants all just comparing notes and saying, yes, this is what happened. Great, we've all got that. Let's move on to the next item. After each block, you don't need tokens. The blocks do the record. The tokens are just there as a medium of exchange. And if you have other ways of exchanging, you don't need one yourself. That's the entire thing. The only real case that I can see for it is with intercurrency exchanges. So like with bricks, as an example. That's why I made Symphony, for the same exact thing. If you have something like Solana, like I don't really think you need it. You can have all of these other tokens that are there. Like you want to run stable coins, for example, like everyone's moving to, then you can have the stable coins run through as the token of exchange on that chain, and you don't need your own.
Okay, so I wanted to ask, right, just since we're still on, like, the token, I guess, subtopic of this, right? Because what I find, like, a lot of Web3 projects, when they're starting out, especially I think in the year from 2022 to 2024, a lot of them were dependent on token launches instead of actual project revenue, right? So let's go a little bit into that quarter, right?
Well, I mean, the token launches, I mean, if we're like, how far back are we going here? Are we going
We're
back
going
like you're talking?
2022, right?
All right, 20, okay, because I think if we're going back to like, 2017, 2018 with all the coin, the ICOs, I'm just trying to distinguish here
Yeah,
between token launching and going back to all the ICO launch mania from 2017, 2018, when every single person, you're getting coins launched every single day.
yeah,
And we know how that most of those turned out, right? So, okay, but if we think about the tokenization and I think, but I think we also have to, think a little bit about what exactly is being tokenized, right? Because there's going to be big differences between what's underlying the token. So, because it's going to blend into what we're seeing with real world assets to a certain degree today, right? Because, that's, I think, the natural evolution of the tokenization, so, all right, let me see if I can get an example. Okay. So I had this idea a long time ago. Maybe we can, let's frame it as a use case or as a potential example. So when Fortnite came out and
yeah.
Fortnite became like this massive, massive thing. And I don't remember who had this idea. I don't know if it was my idea or someone that was around. I thought it was a brilliant idea because how crazy Fortnite became. And then, you have all these weapons and then there were like exchanges and stuff like that for the weapons, for the, like your equipment in Fortnite. Were you guys Fortnite players?
I know I was a big one back when it came out.
Dave, were you a Fortnite player? Because I never played. So you might have to correct me about the mechanics of the game. Because I know what would happen. If I start to play this game, I would never stop. And then that would be it. It would be done. Okay. I'd just be playing it all day. And I got that kind of addictive personality to video games. So there's no way I ever would pick this thing up. So anyways, you understand what it was like to arm, get the equipments and everything like that. So my idea, because this is right back in the token, like everybody's just walking around, what can I tokenize next? What can we tokenize, right? So my idea was, well, hey, there's so much potential for fraud with the weapons and everything in the armory, and Fortnite tokenized the bloody weapons so that you could trade them and have proof of ownership, put everything on the blockchain, put Fortnite on the blockchain, the equipment. I thought that was a brilliant idea. So the idea here is, okay, what's the need? Well, there is a fraud or something like that. You needed proof of ownership. You needed something on a smart contract. In this case, it would have been like your Fortnite, your personality, your weapons, everything. So tokenizing it allows you to get that proof of ownership and get the smart contract going. All right. Now, how do you monetize that? Well, that's an entirely different question. So that's the reason why I brought that up, not just because I find it funny. It's just that's what the idea of tokenization really was, right? The whole point of tokenizing something means there has to be a need to put it in a smart contract and in such a way that people can exchange it. That's really the goal of a tokenization. It's proof of ownership and the ability to transact it. Great. So once you've established that, well, then it's really, will people exchange it? And then how do you make money off of it if it's being exchanged? And there's a real demand for it. And that demand has to be somewhat persistent and it can't be a fad. And look, we have so many areas right now where this is a young industry. A lot of it's just going to be a fad that's just going to fizzle out over time. So that's the way I look at it with the tokens. And, it's like, what are you tokenizing? Why are you doing it? Does it require a smart contract? And will it be exchanged? Because that means there's utility. If there's no utility, well, then you're just buying it and hoping the prices goes up. And what's going to drive that price up? Is it just a greater fool theory where someone's going to come along and pay more than what you did? That's not a great business model. So that's the way I look at it. You need that utility behind the token and have the need to exchange it, for people to exchange it.
So
I don't know if that makes sense to you. That's the way I look at it.
Yeah, it does. It does. So based on, like, let's say supply and demand of like an NFT or a tokenized asset, does it really help or like distort like certain, revenue models for like the business?
I'm not sure I understand the question. Can you say it again?
Okay, so like, when you're tokenizing something, right? And based on supply and demand, right? Does it necessarily help like, certain revenue models?
Well, I mean, absolutely. I mean, I think you got to back up a little bit, right? Because if you have the supply and demand for the product, okay, if you have the demand for the product, let's start with that. If you have
Yeah,
demand for the product, you need to have
yeah,
the supply to satisfy the demand, and that's going to really determine the pricing model and everything like that. But ultimately, I think what it comes down to, because what we're talking about here is really the business model. If
yeah,
there's the supply and demand, you got to understand really, who, like, who's paying it, who's going to pay for it, why, how,
mm,
why would they stop paying for it? So I think you really need to do that kind of analysis first. I mean, the first thing that you really need to do is, is you got to ask these questions. Like, you got to ask questions like that. All right. So if this is my product, this, like, how am I going to monetize it? That's the first question. How can I monetize the product? So, and that gets a little bit different if we're talking about a token, or if you're talking about a service, or you're talking about like a hard asset or something like that. So, it's the revenue mechanism that you're going to pick for it has to, match the product, match the demand, and match what the users are going to, what their experience needs to be like. So is it going to be a transaction fee, or is it a subscription? I mean, there's so many different revenue models that you could dive into here, right? Do you start with a
mm,
little freebie and give away a freebie, and then you try and upsell people to a subscription model? But if it's, it's really depending on what the product is and how it's going to be exchanged and used by the users, that's going to determine the revenue model, or at least
yeah,
what revenue model is going to work.
yeah. I completely agree. I completely agree. And let's just bring it back to, like, the token section again, right?
Yeah.
So I want you to give me an example, Corda, just your own example, right? When do you think, like, tokens really help a project or just break the overall business model, right? Because, so with some, sexes and dexes, most people don't even use the tokens that they have, right? I know one of the biggest exchange, Binance, people love the tokens and the utility of the tokens. Like, it helps with trading fees on top,
Mm-hmm.
digital assets on the platform. And not only that, it's very valuable itself. I think BNB is setting at like 300 or 400 right now, and it's not even near its all-time high.
Oh, yeah. I don't even really know how to answer that one. I mean,
David, you want to go, let Corda
yeah,
answer?
I want to hear David go on this. I got to really think about that one, give a good answer.
Well, Binance has a good business model.
Yeah, that's for
They
sure.
Yeah,
Hmm.
they went across many different countries, Binance.us excluded. But they went across many different countries. They did a lot of things. They gained a lot of value very early on. I don't think their token had anything to do with that.
Yeah,
Hmm.
I
I
don't think
agree.
that they're. I think that they could do everything that they're doing completely without the token and be just fine.
Okay. And do you think other
Most
Web3
people are not going to
companies?
be in that position, though, right? That's the thing. I mean, like,
Yeah,
so if most places need the tokens, most other businesses are going to need the tokens, but the tokens need to be an incentive mechanism. They can't be the product themselves. And I think that's really what I think is the key point there. The token just has to be part of an incentive mechanism for the users to use, to do what they're supposed to be doing with the product. It
yeah,
can't be the product itself. I think that's what we've seen fail as a business model, is if the token becomes the product as opposed to the token being an incentive mechanism inside the product.
yeah. Okay, I completely agree. So,
Yeah.
let's talk about, a little bit of yield models, right? So sustainable and unsustainable, yield farming, right? Can you go a little bit into that, David?
Well, when it comes to yield farming, you have notable examples like Terra that
Mm,
exist, as well as basically the Cosmos ecosystem.
yeah.
Now, when crypto was started, you had Bitcoin, and they had a max cap, very specifically because it came out of the 2008 financial crisis, and you had everything that was going along with money printing there, bailouts, and all that stuff. So they made Bitcoin as an answer to that, as a way to prevent money printing and to keep track of where money was moving. So, like, you then had Ethereum come along, which threw out the maximum cap and said, all right, well, we'll just print a certain amount every year, and that's going to be it. And then everyone else basically copied that. With Cosmos, they came after Ethereum. Like they came and basically copied Ethereum, and they're continuously printing more every year. This is, I don't remember, this is, I'm pretty sure, as a percent, not as a flat amount, the way that it was on Ethereum. But like Ethereum's approach was that, yeah, we're printing this amount, but it's going to be less and less as a percent compared to the maximum amount, or the amount in circulation every year. Cosmos, they just print the same percent every year. So yeah, like that's basically doing the same as the US government. Now you have a lot of people in Cosmos that are wondering, like, why isn't the price rising? Why is this like we've done so much and yet it's still under $4? Like, yeah, you're printing money right there. You constantly have more and more tokens. You're inflating the amount. Each token is worth less the more you inflate it. So this is a failure. This is a failure to monetize there. This is a failure to create proper yield incentives. What they're doing is they're printing more so that way they can use it, and then all of their holders are losing out. None of their holders know what's going on, same way most US citizens don't know what's going on, but they're printing money. So like, when you print, when the organization prints money, effectively, you're the exit collateral.
Yeah.
So that's what's
inflation.
Happening.
It's also a definition of inflation, really. So yeah. I think also explain that, yield farming, most people, if anyone, don't want to assume that everybody out there even knows what yield farming is, right? So essentially you're locking up crypto in a protocol, right? So you're giving somebody your crypto in exchange for yield. Like, it's like a bond. You're lending money. In this case, you're lending crypto and you're being paid back in tokens. So the question is, what exactly are you being paid back in? And how useful is it that what you're being paid back in? But the problem with it is that, it's a commoditized kind of business, because people are only going to be there as long as the yield is high enough, right? As long as the APY, people are just going to follow the highest yield. But the problem is just following these places that have the highest yield is a mistake, because first of all, they're just paying you back in these tokens. They're just paying you back on almost the same thing, that there could be no value to the token that they're giving you. And people are going to only hang around as long as you have the highest yield. So, if you can fund the yield through real revenue. So if you're thinking of building these kind of yield businesses, right, you need to fund the yield through a real revenue stream, right? Because that's the incentive and everything like that. And getting the tokens, being paid in the tokens is the incentive. So you need to have something that really backs it. Okay. So, Uniswap was a good example of it. But if the tokens are, tokens emission, like giving out the tokens, that's the yield. So you're being paid back in these tokens. Now, the yield farms are essentially just printing out these tokens and paying you back with it. So if you have 1,000% APY, which is ridiculous, you're going to attract insane capital. Oh my God, I could 1,000%. That's insane. But, the problem with that is it'll collapse in, that means they're issuing so many tokens to pay you back in the yield. That's inflation. And that's going to, in real dollar terms, those tokens become kind of useless. And then what's going to happen is you're going to start seeing exodus of capital when people realize the real purchasing value, the utility of that token's gone down because you've just printed billions of it. Well, then your company's dead. Okay, you've just, capital will flow in, capital will flow out. It's just a commoditized kind of business. So that's the danger with the yield farms. And it's one of the reasons why I've been very nervous about anything with yields, because I never really understood what they're paying me with and what is staking it. Like, what is really going to back it? And it needs to be backed with real revenues. It needs to be backed with something real. So that's a very different, in my opinion, it's a very difficult business model, because there's nothing that distinguishes you from anybody else that's doing it. most of the time, and it's just garbage in, garbage out, and these things don't last very, very long because there's nothing really to it, and the tokens have no value.
Yeah.
That's the way I see the yield farm.
And so far that covers the staking aspect. There are a couple of others as well. For example, with stablecoins, you saw other yield aggregators. With Terra, you had one. With another on the Cosmos space, you had another. The only thing that they changed was the backing system. So they changed one from the Terra system of there is no backing. You burn one side, mint on the other. And then when the math fell apart, that's when that fell apart. But what accelerated the math falling apart on that was that they offered yield that they could not sustain. They offered something like 20% APY, and at best, what they were pulling in was something like 2, 4. So they were very effectively giving away money that they could not sustain through the protocol. And when people went to sell because of an exploit, then that just triggered a runaway thing because they didn't have any backing, like at all. They never created a backup system. Now, I don't mean the Bitcoin that they said that they bought. I mean literally on chain, they had nothing backing it. Like they did not set aside any Terra, they didn't set aside any USDT. They didn't include any blocks or gates or anything along the lines. It was very literally the entire thing, end to end, which people kept on telling me I was wrong about. It's in their white paper. It's still in their code. You burn one side, you mint on the other. That's it. Now, when another one came along, they forked Terra, essentially. They copied the protocol, and they blamed it on the backing. The backing wasn't the problem. They changed out the backing from one to another of a basket of currencies. So they had Bitcoin and Ethereum and other things in that basket of currencies, but the problem still was there because the problem was the protocol. And then they did basically the same thing in a different way. They didn't offer a higher APY. Instead, they took what they had with their backing and they gambled it. So they put it on leverage in various other yield aggregators, and when those failed to make a return, they lost, and so their users lost. So any yield aggregator, you're effectively buying into the company and any decisions that they make because you're getting their tokens, and should they fail, then you fail. And if we look at other stablecoin providers, the ones that have come around recently, the reason why most people are backing them, the reason why most people believe in them is because they're using bonds. Now, with a lot of these, they basically say, yeah, we're using bonds, or in the case of Athena, they're using delta neutral strategies, which sounds fancy. No one looks into it. Okay. Now, with the ones that go after bonds specifically, what you had effectively was them saying, yeah, we're backed by government bonds. You sell here, you get dollars. Like, bonds aren't dollars. Bonds are the promise of future dollars. But that aside, you get the dollars. Great. Okay. Yeah. You have Circle and Tether. They've been around a while. They've had their own issues. People have ignored those issues, but let's ignore those too for now. So you have bonds. You go into those, you buy those, and you get a certain yield. Bonds give roughly 4 to 8%. Great. What are these guys offering though? They're offering something like 20%, 16%, 20% in order to go over to their protocol. And so where's that money coming from? And no one wants to ask that question. You go over to them, you get this super high amount of basically them borrowing their own money or something, I don't know. But they're offering you this high rate, which they cannot manage. And they're doing that in order to try to one up each other all over the board, in the same way that you did before with Terra and the others. Now, should they be able to manage that? Great. Should they be able to roll it back properly and get back down to maintainable levels? Great. I don't know if they can. I don't know if the U.S. government can either, because they're going to be running into some issues. But when you buy into the token, including when you buy into stablecoins, you're buying into that system, that the organization that issues those tokens. So you can trust Circle or Tether or the organization behind them, the U.S. government, And at whatever level you want to trust at, that's like you've got to trust them and everything behind that as well. And should any of those fail, you fail, because like, yeah, it's going to fail at some point. Everyone does. Circle, they had to get bailed out by the US government because the Silicon Valley Bank went down. Literally every single organization, every single yield aggregator, they have that base problem. Can you trust the organization?
Yeah, agreed. So I think just to close off a little bit on the yield farming, the way I would say if you're operating in that space or you're thinking about it, I mean, I think you need to ask yourself a number of questions if you're the founder inside a yield, in a yield and a staking kind of thing like this. One, what would happen if you turned off your token emissions tomorrow? Let's say you stopped giving out new tokens. Would people stay? If people will not stay, I think that sort of tells you what's going on. And is the yield funded by real revenue, or are you just diluting existing shareholders and by issuing new tokens? If you're just issuing new tokens and diluting the existing holders, that's kind of the definition of a Ponzi scheme. So you got to be a little bit careful there. You need your yield to be funded by some kind of real revenue. Okay. So the question then is, how are you going to get from this kind of liquidity incentive, you've given people, you're generating your liquidity through the incentive of giving out tokens. How do you get away from that and move to an organic kind of liquidity based on internal revenues or something like that, and not just by issuing new tokens? And this is what always scared, and again, this is what's always scared me about the yield and why I've never really done it, is I felt like it's a Ponzi scheme. I'm just being paid back with my own money or being paid back with other money, and people are going to get paid back with my money. And then the tokens that I'm given are really have no value whatsoever. So, are there legitimate uses to yield farming? Absolutely. There absolutely are. Okay. It's just, I don't consider yield farming as a business model in itself. It is a tool to help you get somewhere. So in other words, if you're building a protocol, and I think yield farming could be a great way to help bootstrap your protocol a little bit, right? Like, this is a very legitimate use case for me, because you use it to build initial liquidity just to function, but you got to move away from that so that it's not all about the tokens, and the incentive for using your protocol is just not about receiving your tokens. There has to be some kind of economic value to your protocol such that people are going to hang around if you were to stop giving out those tokens, which eventually down the road you're going to want to stop. If you're yield farming, giving out tokens, that's your business model, I don't consider that a legitimate business model. I do not think you're going to be able to monetize that or make money. I think you're just running a kind of Ponzi scheme, and you're going to be attracting the wrong kind of users that are going to be in and out, and whoever gets out first is really going to be the one who wins. So, your test is really what happens to your TVL and trading volume if you cut out on the token emissions. If you cut out your token emission rates and your TVL stays locked, then you're in a good place.
And I think like a good example of this would be like, when the collapse of our FTX, when Binance said like, we're gonna stop trading your token, and like the entire exchange just went into like absolute, rubbish, right?
Yep. I mean, there's a number of examples. I'm trying to remember the other ones like that were similar to this. I know we had a couple of ones like a few years ago. It was like 5-6 years ago. Was it Olympus? Was that one of them? Does anyone remember that name?
It sounds familiar.
Because I remember that one collapsed. I think it was Olympus. I don't remember. I'd have to really do some research into it. But I think Olympus was one of the ones that had like a kind of Ponzi scheme, like going. I wouldn't call it a Ponzi scheme, but it wound up being that kind of collapse where they thought that, the internal momentum would keep it going. What do they call like a Nash equilibrium would keep pushing this thing going, and it wasn't, and it just became like, diluting everything until the point where everybody just got the hell out of this thing. I don't remember this one very well because I really don't remember, but I think that was one of the examples.
Yeah, but the thing with FTX, it was absolutely mad. It was like $8 billion worth of like people's crypto in their wallet, absolutely gone.
Well, sorry, can you say that again? I didn't hear that. What happened?
Yeah, so like the FTX situation, it was $8 billion worth of crypto that was like stolen from people. So it was like genuinely one of the worst things that would happen in like the crypto, in the history of crypto, regarding like a Ponzi scheme.
Oh, really? Yeah. Well, yeah, but that's yeah, okay. But I think it was. I think no, I thought it was more just in terms of the investors. Well, maybe it was. I thought it was more like the investors or the people backing the company. But yeah, no, it all sounds familiar. I mean, but that's exactly. I mean, that's the definition of a Ponzi scheme, right? Is paying back people with new money. You know, paying back the old people with the new money coming in. I think that's kind of what the Olympus DAO was, because I think it was. You know, they were trying to create, I think it was like a decentralized reserve currency, and I think it was meant to hold like backed by. They were trying to back it with treasury assets and not peg it to the dollar like a stable coin. That would have been the difference between it. They weren't trying to like create a token and peg it as a stable coin. They were backing it with like treasury assets, and I think the token was OHM. I think it was OHM. Now that rings a bell. I think the token was OHM. And they tried to stake it, and you know, I think that it was sorry, I'm blanking on what it was supposed to do, but they were paying ridiculous APYs. I think they were doing something like 1,000%. I think it was even higher annualized, and they were funding this by just continuously issuing new OHM, their own token. They were just continuously giving it out to the stakers, and it did really well at first because of the high rates, and I think it also generated a lot of excitement. People started like, oh, I see other people doing it, I want to get in too. So it had that FOMO kind of thing. And then I think they had about, I think they got pretty high up there in assets. I don't remember exactly how high they got. But the problem, what happened is that people started to dump the coin. So as people started to get tired of it and realize there was no real value to it and that these yields were not sustainable, they started just selling. And then it was like a classic bank run. And they were just essentially paying yield by minting new tokens. And that only works so far, because if people start selling, well, then the price is falling like crazy. The tokens aren't worth as much. There's no incentive for people to hang around, and it just creates that positive feedback loop until the whole thing just collapsed. So, I mean, that really, that's the danger of all of this, or pretty much any of the business models, where it can turn into a Ponzi scheme pretty easily. If you're just paying people back by issuing new tokens, that's not a good business model.
Sure, completely agree. And I want to bring things back to the monetization, because we already finished talking about the topic of yield farming, right? What about creator and community monetization, right? So like, let's say you're monetizing communities and memberships with tokens or even NFTs, or any kind of incentive that really is like I guess specific to your project or even community, right, as a creator, right? So one thing I want to ask for is, creator coins and like social tokens still relevant, or is it like fading in like the big 26?
I don't know if it's, yeah, Dave, go first, man. I've been talking a lot.
No, I really don't. I never liked NFTs at all. With those, I always thought it was paying for a JPEG, and then I looked into it and I thought, oh, well, you're not even paying for that. You're paying for a link to the picture. Okay, so you don't even get the picture. You just get the link. Wonderful. So in this case, you have NFTs, and yeah, you can throw in other things on them. No one ever actually did what you're supposed to with them, which is exactly what Cordell was talking about. With you can make things in games be tied to these, and have that be tied to ownership, and show that. You could have them be tied to stocks and automate dividends or anything along these lines. Anything regarding ownership, you can do that. And instead, what everyone did is link to a JPEG. Congratulations, you have this pixelated image that was auto-generated in some manner. Now, you have some of those that get tied to communities, and great. They may have a wonderful marketing team. They may draw in some people. Those people are going to leave. That community isn't going to really have anything, and those people are going to leave. Let's take a look at one of the largest ones. With regards to Board Ape, the Board Ape Yacht Club. Is anyone still talking about that? Like, what's the value of those? How many people are still in that? You had people buying those for millions, literally links to JPEGs. They were buying them for millions. And now what? Now they're what, like $30? No one's going to be sticking around for that. What did they want to do? They wanted to create a restaurant, and they didn't even do that well. So
Dave just
like, I don't think any of these communities are going to be sticking around, because the one with the most money, the most traction, the most people, they didn't stick around. I don't think any of the other communities will either. You kind of have to have something going in order to be a community, and it can't just be static.
Yeah. I'm a little bit mixed. I mean, because you said, is the 2020, like, in 2026, is this community thing still valid? And I'm like, I think as long, I would say that the popularity of them, the appeal of it has definitely lost its shine a little bit. I mean, to me, it's like the shiny new object. Oh, it's fun. It's a community thing, whatever. But I think ultimately, if there's no utility to it, if there's no utility to me being in your community, then no. I mean, like, there has to be something, there has to be a reason for it. There has to be a reason why people are going to hang around. And it's not the same thing as saying, oh, hey, I've got a Discord server with 50,000 members on it anymore. So, I mean, I don't even remember if I've heard people say that anymore, talk about how many users they have on a Discord server or something like that. But, because remember, if you're monetizing on a community, it means the community itself is a revenue source or the distribution channel. So what are you doing with that community? Web3, that goes even a little bit further, because, the community can be the source of capital to help raise money and stuff for projects and things like that. And that, to me, would be a little bit more useful. It's kind of like a crowdfunding or something like that. But, it's that those kind of models are tough. The community models, you really need to have something really useful that makes the community want to hang around. So the community has to produce something valuable for the company too. Like, what is it? Maybe is it like open source coding? Is it research? What, I don't know what it is. Are you having people audit your code? It really depends on what you're going to use the community for. So, like, you as the company have to be able to derive benefit from the community, something that's going to help you make money, which I don't know what it is. It really depends. Just creating community and managing community is not going to do anything. So, and then what does the community get for being a member? What's in it for me to stick around and keep joining conversations and help out? It can't just be on some kind of speculative upside. So, and I know there's other examples of it, but you can't confuse having an engaged community with revenue. Okay, so let's say you create a Discord server. High Discord activity does not mean anyone is ever going to pay for it. That's if you're trying to charge for the community or whatever it is. Okay, if you're trying to use your token as a glue to keep your community together, I don't think that's going to work either. And even if, let's say, you manage to recruit some big name influencers or something for your community, I've seen that done in the past. I think we had so many of these NFT projects, get on board with like influencers. None of them worked. So, ultimately, you need a loyal base that's going to hold your token and that could help fund you, whether through grants, or they will test your product and give you honest feedback or help you with code. There's got to be some kind of value you're going to derive from that community. And there's got to be value from me being in the community at the same time. So, and don't forget this about communities. They are expensive to build. What I mean by expensive to build, they take a lot of time to build, and you need to be on it all the time. People have no attention span nowadays. Top of that community and constantly doing something to build the community and keep it going, it's done. It'll fizzle out so quickly. It's a brutal business model, community styles. Very, very tough.
Yeah, and I completely agree with you.
If you agree. So
yeah, I completely agree. And most people need to understand again, like, utility is necessarily like the backbone of most like NFTs, right? Just saying, right? Because the Bored Ape Club was mainly built on like hype and scarcity, right? The price dragged it up, the marketing was great. And you had like a lot of celebrities buying it and buying like two and three of them and like, flexing them. I think that really attracted most of the people because of the hype, right? But at the end of the
Yeah.
day, it's mainly like infrastructure that really keeps people around instead of like, community ownership or anything like that, right? The infrastructure of the product. We're talking about nodes, custody, compliance, data, APIs, stuff like that.
Would you ever buy an NFT? I mean, there's a question right now. Would you buy an NFT? David, have you ever bought an NFT?
I've bought one before.
No,
Yeah.
But
What did you
and I don't think you would.
what did you buy? I'm
Well,
curious.
no, I would buy an NFT if it was something like, okay, open up your phone to this wallet and we'll scan the QR code that shows you have the NFT. That's your flight ticket to go over to this place. Complicates things a little bit, but yeah, I would buy it in that case. If it shows ownership for something specific that I need, that I'm going to use, sure. Outside of that, no, not at all.
Okay, well, I think that's a little different because now you're just talking
Yeah.
about putting airplane tickets on the blockchain, which isn't, makes it perfect sense to me. But when we're talking about an NFT, let's say someone says, I'm about to put all my baseball, we're going to now, instead of producing baseball cards, we're going to produce them all as NFTs. Would you ever buy a collectible or a piece of art that's put on as an NFT or that's tokenized, that kind of thing? Would you ever buy something like that?
So, let me go. So me personally, I think, yeah, it's great to really like, put certain things on the blockchain, right? Because, again, they can be forged, stuff like that. And the data for the blockchain is right there, right? In terms of what David said before, in terms of if I would buy an NFT, I think like, that is a great example of what David used, but also for, something like, your residential ID, let's say your utility bills, or even like your driver's license. I think those are very great use cases for, NFTs. And I think we actually talked about them on the previous episodes.
We did.
Yeah.
I think we did talk about the potential for identity and things like
Yeah,
that.
like
And I agree with that.
Yeah.
I agree with that. I mean, those are the genuine uses of getting a lot of important things on the blockchain, or diplomas. Remember, I think we also talked about the idea of getting diplomas on the blockchain because of how many people just walk around saying, yeah, hey, I've got a degree from Harvard, and who's going to check? But yeah, it's just because when I see, I think it's the gimmicky. Again, it comes down to utility, and it comes down to are you just trying to capture on a short-term theme and make a very quick buck, or is it something that really will help the financial system or just society as a whole? But those lines get very blurred because of greed. So, and
work. If you were to create a card game, like, let's take a look at the old Yu-Gi-Oh show or Magic the Gathering. In the old in Yu-Gi-Oh, back from like early 2090s or whatever, you'd have this guy that's running around with playing card games, and then you'd have other games that use the same characters. That's what people were advertising with NFTs. It's like, oh yeah, we could throw these in games. You could then use the same things across different games, and and you can literally take the things that you paid for over here and use them over here. And that would have been basically like that. Like if you could buy a Fortnite skin and then reuse it over in Halo. But like that would be a perfect use case to buy NFTs. It works for collectors. It works for gamers. It allows you to get utility as well as potential value because of the demand. No one did that. What everyone did instead was link to a picture. Like you have this URL that you paid for. Congratulations. Now, and like should we ever remove the picture, sorry, you're out of luck. You paid for the link. Oh well, guess you should have read the fine print. But with NFTs, like I wouldn't get them. I'm not a collector of anything, but yeah, I would not get those unless it was that I could buy in and then have something or get something out of it. I'm not a collector though. Everyone else that is, well, they lost millions on a collection that they bought into. They probably had the money. A lot of those celebrities definitely had the money, but anyone else, I guess they're just out of luck on that. Like you buy into a collection, like what, Beanie Babies, and when the value of that collection drops, your money drops with it. I buy things. I buy stuff. I'm a little different.
I know, but I agree. I'm the same way. I mean, like I would not buy collectibles as an NFT. Look, I'm not a collector. I'm definitely not a collector like that. Aside from maybe I've got a huge music collection, especially covering Fish and the Grateful Dead. I think I have every single Grateful Dead concert and spanning 30 something years, thanks to my brother putting all of that together. But, I'm into like, it's utility, as you just said, David. It's all about utility. Like I'm not the kind of person that's just going to buy something, stick it in a safety deposit box somewhere and have it sit there for 50, 60 years, like a Wayne Gretzky rookie card or something like that, which I do know a couple people that have a Wayne Gretzky rookie card in safety deposit boxes, or if they have a Mickey Mantle, baseball card, rookie card. But I don't know. Like I think what matters a lot here, and I think we should close it out after this, is just that, we've seen these crazes, right? We've seen these fads go through the Web3 blockchain domain over the past 10 years now, starting from the ICOs and then the NFTs, and now we could argue it's the yield staking and things like that. I don't believe that many of these business models are sustainable. I would even doubt that many of they're if I would even call them a business model. But these are the signs of a new industries where people are trying things out. This is the entrepreneurial kind of spirit that's going on in a new industry. And it's important because, if you look back to 2000 and the dot-com bust and everything like that, people were trying new business models. Most of them were terrible, but some of them succeeded. And then they're the leaders and they push through the next generation of technology. And that's exactly what Amazon, Google did. And we could even argue Tesla's in the process of doing that now. So this is a necessary kind of phase of a new industry. And you need entrepreneurs, you need people to test it. If you're the founder trying to build it, yeah, I get it. You get so excited, you're passionate about it, but you really got to question the business model and really understand your clients and your users. And are you going to generate revenue from your user base, or are they just going to get out the second, your freebie or your token emissions, whatever, they stop, they lose value. So I think that's what it is. I mean, we're going to see who the winners are. And I think that's what's necessary to push the industry to the next level.
Yeah. So one of the things I wanted to ask Cordell, or ask our viewers before Cordell closes off, is that should you monetize from day one or later down the line? I think that's
you need to have the monetization plan from day one. If you have not assessed your business model from day one, you should not be doing anything, because you're just going to wind up wasting a lot of time and a lot of potentially money. And if you're okay with that, great, go for it. But if you do not have a good idea of how to monetize it, don't do it. I mean, you could pivot as you go, as we discussed, last week with the pivoting and everything. A lot of times people start with that plan, it doesn't work, and you have to pivot. Fine, but have a plan before you start. You should have a decent idea, and you should have absolutely have looked into, at least spoken to users. Like I said, you got to do that test first. Speak to your users. You don't tell them, just say, address the problem. How are they trying to solve it now? How much money have they been spending trying to solve that problem? That's going to give you an idea for how to structure your business model. But it all starts from talking to people and understanding what they need, what their problems are, and what they're trying to do today to solve those problems, and how much they've spent on that. That's going to help guide your business model. But if you do not have a business model or a plan to monetize, I fear you're just going to wind up wasting a lot of time. Yeah, and I've seen it. I've seen it.
It's mainly looking at let's say what you're doing, and then just saying should we start monetizing from day one, put out a subscription or whatever, and then go forward from there.
Yeah, something like that, but always keep in mind, that it's not easy also, because whenever you ask people, you talk to friends, or you talk to people, you get advice from other people in the industry. This is my idea. This is what I want to do. Do you have any advice for me? Always remember that most people want to see you fail. All right. Ultimately, whether it's out of jealousy or just trying to sabotage you or something like that. Most people are like, you talk to 10 people about what you're building or something like that, 9 out of 10 are going to tell you it's a terrible idea. Don't do it.
Mhm.
And whether or not, most of the time, maybe they're right, maybe they're not, but you just have to remember when you start asking people and for advice about your business model and everything like that, is most people are going to want to see you fail. So you have to be able to really look at things objectively on your own and make your own decisions with it. And don't rely too much on other people, because you might have a great idea. You might have a good business model, but everybody else around you just wants to see you fail. So you have to really know when to trust yourself and when to trust the opinions that others are giving you.
Completely agree. And I think we can close off there. Cordell, do you want to do the closing this episode?
Sure. Well, I just want to say, in this week's episode, we wanted to really do a little bit about, talk about business models, how you can monetize in the Web3 space. We're hoping that everyone out there got a little bit of a sense for making sure that, that there's utility behind it, that your users want it, that if you're just going to go out there and offer tokens as your business model, you might run into some problems. So, you think it through. Always chart out the resources, what's going to be needed to produce the revenue, how you're going to interact with your clients, that is your customers. That is the most important thing. So we want to thank you for tuning in once again to another episode of Crypto and Coffee. What episode was this? I've already lost. Is this 20?
This is 18. We have 2 more episodes.
18.
Yeah.
All right, we got 18. All right. So I think we want to thank everyone for listening. We love you all, and we hope to see you for episode 19 soon.
All right.